Us now via video link. Pamandla, thank you so much for the time. The decision split 3-2, still holding rates though. No surprise really, surely.
No surprises, Arabile. Thanks for having me. And I think that given what the SARB has done this year, so far 300 bips cut, and at a time when majority of the economy was under lockdown, I think it's reasonable for them to want to, take a step back, take a breath, and assess the impact of the stimulus or the interest rate cuts that they have given us so far. But if you look at the fundamentals, I do think that there is a chance, there is scope for further easing, maybe another 25 bips cut, which we have penciled in for early next year, but an expected decision.
Yeah, I'll play devil's advocate here then, Pamandla, and say, we thought that they'd gotten a break in the last MPC meeting where they said, we're going to hold rates, there's enough room to cut, yes, but we're not going to do so. So yes, they'll take a step back and assess whether this is enough. Was it enough then, and is it enough now?
Look, it's a good question and an important consideration, but you need to think also of what's happened since the last MPC meeting. I mean, we saw the budget, which in our view increased the country risk a bit, just a bit, due to that rising debt to GDP ratio. So there's still lingering uncertainty also around whether we will see a seamless transition of power in the US, for example, and what if that is not going to spook the market. So it would be prudent for them under those circumstances when uncertainty has lifted a bit, slightly, to want to take a step back and assess data as it comes in, as they always tell us.
Yeah. We've always said that confidence is very important in our economy, right? Because the more confident you are in the economy, you continue to spend a whole lot more, etc., etc. Would another cut not perhaps, and I know I now seem like I'm advocating for a cut. I'm really just playing devil's advocate and just asking the question here, but would another cut not boost the confidence of consumers, making them want to spend more, therefore making our growth figure or our contraction for this year even less than we're currently forecasting at 8%?
Look, from where we stand, we agree with that kind of an assessment, particularly if you look at where inflation is coming from at the moment. From a demand side, there's literally nothing. The governor made mention of temporary relief on insurance. That's a big component. That's a big item in our basket. You look at what's happening in the housing market, where rental inflation continues to trend downwards. And in fact, there is a possibility of it touching 0% and even negative. So from a demand perspective, it definitely isn't much there. All the bets that we are seeing of inflation right now is coming from the cost side. It's coming from administered prices, so electricity and water and the like. So a cut really would assist in at least stimulating demand. We have seen it in the housing market. Of course, it's probably not going to last too long after this, given that we continue to lose jobs. So a cut under these circumstances, I think, would assist in boosting or at least supporting demand.
Yeah, we're seeing inflation rate perhaps stay for the longest time within the target band, within the midpoint of that target band as well. Are administered prices, electricity increases, petrol price increases and the like, are those the biggest risk to inflation really at a time like this? Or is it really just the opposite way, where you have people not having things like salaries as well, a drawdown in how much they're earning as well, which means that they're spending less, which will hurt inflation as well in future? Which of the two do you think is the bigger tug in this tug of war for inflation?
Look, you can increase interest rates all you like. If administered prices, you can increase interest rates all you like, but administered prices aren't just going to react to that. So it's not a market-determined price. So under these circumstances, my personal preference would have been to focus more on what is happening on the demand side, seeing that the interest rate instrument is more. The interest rate instrument speaks to the demand side of the economy. So under these circumstances, given the nature of the shock as well, I would place more emphasis on the demand side rather than on administered prices.
Yeah. Okay. Gets interesting. So do you see another cut then maybe early next year, middle of next year at the very least?
Yes, so from our perspective, we think that looking what inflation is doing at the moment, you made mention that it's within the target band. It's firmly below the midpoint. In our focus, looking at the housing market, there's pressure there. Looking at the insurance market, there's pressure there. So that's the biggest component of inflation, so the services part. And we already know that demand at the moment is quite weak in the goods market. So inflation isn't coming through. So for us, looking at the fundamentals, there definitely is scope for an additional 25 bips cut, which we have penciled in for early next year.
Yeah. Isak Odenda also still joins us right now as well. Of course, he is investment strategist at Old Mutual Wealth. Isak, just very finally, I suppose, from your end, just some closing thoughts with regards to the basis for any further rate cuts from here. Would inflation have to keep going down? Would South Africa's economy have to completely stall? Or, what would be the case for something like that?
Yeah, let's hope the economic recovery doesn't fall over. I think, if the inflation outlook improves a lot, and I think for that you'll need a substantial appreciation in the rand, I think that does open up scope for the Reserve Bank to cut again. But again, it comes back to the fiscal situation. I think maybe come the February budget, there's a bit more detail, there's more clarity in terms of how the government plans to reduce the deficit. I think that could give the Reserve Bank confidence to then cut rates in the face of very muted long-term inflation.
Yeah, certainly does get very interesting for them. I think they have a whole lot of work still to do, clearly, as the South African Reserve Bank, Isak. Do you think that perhaps more cooperation, more collaboration, more interest in I suppose, in the global sphere is necessary? Because you look at other reserve banks, that is, other central banks, and how they're looking at the economy is also just from a jobs point of view. And it's, again, perhaps that dual-pronged approach is not just inflation, but having a dual mandate. Should that be a question mark for the Reserve Bank, something they consider in any small way?
They're supposed to consider the impact on the economy anyway. So although inflation is their primary mandate, they have to look at it in the context of growth and development. So I don't think that would change it fundamentally. I think it's the way they've interpreted their mandate is to say we focus very much on inflation, but we also focused on this risk to inflation some point down the line. Should there be a fiscal crisis, the rand blow out, and then you have a inflation jump because of that. So I think it's also the way they've interpreted their mandate. Probably a bit more broadly than just purely looking at expected inflation.
Yeah. Spamandla Mkhwanazi as well, getting back to you, I'll ask pretty much a similar question then as well for the Reserve Bank overall. The interest here will be just how they can continue to help consumers over the long term. What would be the ideal case for a cut if that were to ever happen, particularly from a Reserve Bank point of view?
Right. I think, of course, inflation outlook is going to be important. I think considerations around how global economy evolves from this point onwards is going to be. They are going to also look at how our debt trajectory, particularly maybe coming out from the February budget, how that evolves going forward, and then assess the conditions from there. But from an inflation perspective, from a demand perspective, it definitely is a scope to further ease interest rate.
And the collaboration then, as I noted with Isak as well, that collaboration perhaps between not just the inflation targeting, but also looking at things like unemployment and the like as well. Has that become more significant now, more important for the Reserve Bank to look at?
Yes, it's always been a consideration, although it's not explicitly stated in their mandate. But I do think that given the crisis we are in, given the levels of unemployment, it would be irresponsible for them not to take that into consideration. And given that we expect unemployment to continue rising from where it is right now. It further gives credence to our expectations.
Yeah. Spamandla Mkhwanazi, senior economist at FNB. Thank you so much for the time. Appreciated. Isak Odendaal, investment strategist at Old Mutual Wealth. Also, thank you so much for your time this afternoon. Really appreciated. That is indeed your breaking news story then this hour. The South African Reserve Bank deciding to keep interest rates unchanged. The prime lending rate is at 7%. The repo rate also unchanged at 3.5%. So what does that mean for the market picture then? Of course, the growth trajectory, as the South African Reserve Bank expects, they say it'll perhaps hit a contraction of 8% in South Africa's economy. That's how they see things faring, perhaps even inflation remaining still within that target range of between 3 and 6%. So what has that done to the markets? Well, particularly on the local front, not too much change there. We're still 1.1% down, unfortunately, overall for the JSE. If you take a look then at your top left-hand side of your screen there, 1.12% down as the JSE all-share, the biggest losers being the financial counters, which have gone down 1.5%. That comes as the bank shares, second to last on that board, going down 1.4% as well. So a big loss there. The only one sitting in black is platinum miners. They've gone up 2.33%, which yes has helped resources not lose or go down by as much, but the overall picture there is still down 0.8% because gold miners have unfortunately taken a more than 4% hit. More interestingly and more importantly though, what has that meant for the local currency? A little bit earlier on, we had fallen by around 1/3% was the local currency against the US dollar. We're now down around 0.7% or having lost around 10% against the US dollar. So we're now sitting at around 15 Rand and 54 cents then against that US dollar picture. In terms of the euro then, it'll cost you 18 Rand and 37 cents, 38 cents or so against that combined currency. We are still losing 0.4 percentage points then as well, while the British pound will cost you 20 Rand and 54 cents. Overall, to check in then on the other commodity market as well, Brent crude is down 1/3% now today, sitting at $44.20 a barrel, while in your other commodities, platinum is down 0.5%. It'll cost you $938 for an ounce of platinum. An ounce of gold, though, will cost you $1,855. That's down 0.8% there. So falls across the board for the a lot of those commodities, and that indeed beholden to demand across the globe, not necessarily just with regards to the picture locally. Let's remember as well that the coronavirus has continued to plague things like demand, hinder just how much demand is required of things like oil as well, which means that South African investors and international investors alike are perhaps looking at what is the best way to get money out of this system. So the tech counters have certainly been the big ones to get into, but will that be a sustainable process going on from here? The likes of Starbucks deciding to increase the amount of pay given to their staff as well has meant that they'll continue to spend more money, right, which boosts an economy. That's happening out in the United States. Is that something the local government could have thought of as well to perhaps help in some ways? The corporates needing to stand in and say to South Africans, we will offer you more, not less in this time, because we need you to help pump more money into this economy. And even though it gives us short-term pain, it will be, however, beneficial for the environment in which we trade in over the long term. Those are the key factors that perhaps could have been played. Alternative economics is perhaps what that was in many instances. But indeed, we've given you the breaking news story then here on our special broadcast for the South African Reserve Bank's Monetary Policy Committee decision on interest rates. As you can see there, an unchanged stance there, 3.5% for the repo rate, the prime lending rate remaining at 7%. Thank you so much for joining us this afternoon. I'll be back then, of course, tomorrow with more On Point. My colleagues then at SA Today take over then at the top of the hour. From myself, Arabile Kumete, and the remainder of the crew here at Auckland Park, that's where the buck stops.